Systems work, people fail. Welcome to InsureMark's Advisor Mentorship Podcast with Vice President Jeremy Hauser.
They say 2024 is the year of value, but like me, you may be asking, where is it? Well, let's ask the experts. Welcome to this week's episode of the Advisor Mentorship Podcast. I'm your host, Jeremy Hauser, and today we have an all-star academic team joining us alongside Tom Haines of the Annexus Group. Professor Robert Shiller is an American author, economist, and academic who received a Nobel Prize in economics in 2013 and created the Case-Shiller Index that provides information about the trends in home prices. We are also joined by Jeremy Siegel, who is an author and American economist who is the Russell E. Palmer Professor of Finance at Wharton School of the University of Pennsylvania and appears regularly on CNBC and other networks for comments on the economy and financial markets. Both professors received their PhD from MIT. And gentlemen, it's an absolute honor having you on today. How are we doing?
Okay.
Doing great.
Doing good. And obviously, we're going to share a lot of good insight here. It's an honor to have both of you on. Tom Haines with Annexus as well, too. So before we dive into a lot of great topics that we're going to discuss, people may not realize that you two actually have a past together. Y'all have known each other for quite some time. So I want to open it up a little bit here at the beginning of the podcast. And as we record here, it's May 3rd. So Friday, some reports came out. This is going to air here in the later days of May. So Professor Siegel, what is one memorable event or moment you have with Professor Shiller?
Oh, we've had so many together. I mean, the moment we met 57 years ago, as you know, the first day of graduate school at MIT, having the families, we vacationed together in the Poconos on the Jersey Shore. So there's I mean, there's so many really good memories of our two families being together and intellectually being together through this more than half century.
No, that's awesome. Wow, that's longer than I've been alive. So you guys have known each other for quite some time. Professor Shiller, is there, how about you, Bob? Is there any moment that actually sticks out or story when it comes to you and your relationship with Siegel?
Yeah, I've been thinking about that. The thing that comes to mind, maybe I'm doing it to illustrate my attitude toward narratives and stories. Most of what we've been through, we've forgotten in life. But some things stand out and we have long-term memories. So what came to my mind when I thought about this is the moonwalk. In 1969, Apollo 11 dropped off a group of astronauts on the moon, and they took a walk, and it was televised. So that is on the memory of just about everyone who was alive at that time.
We watched it at our house. We watched it at my apartment, didn't we, Bob?
That's what I was going to say. Yes, Jeremy, I was asking Jeremy about this, and he didn't remember at first. But I had to check. Is this a false memory? No, I remember it really clearly. So, but I went and did some background check. I used to write letters to my parents. This is in the old days before we had mobile phones. And I told them, Jeremy invited me to his apartment to see this not to be missed event on his television because I didn't own a television. So it's absolutely a fact that happened.
Right. I know we saw it together. I didn't remember where we saw it together. Yeah.
And
that's how far back. That's how far back. I mean, we have memories going all the way back. I have memories. Bob and I used to study together in the MIT library, connected to the economics department. But that would it was closed like at 11 p.m. we would walk the long corridors of MIT all the way to the Student Center, which was open 24 hours, and continue our study. They had a little place for a snack. We'd have a little snack, and we'd continue to study. There's just so many memories going back so many years.
It's incredible, and I know we have decades of memories. Something that's very eye-opening too. I know Tom was mentioning this to me prior to recording. So you two actually haven't done an event together collectively in quite some time. It was actually back in approximately 2020. During some crazy times of what was going on around the world, especially in our country. And there were some predictions that you guys laid out when y'all were together on a webinar. One of those was with you, Professor Siegel. You actually mentioned that your prediction was going to be very high inflation. That hopefully, it depends on if COVID gets under control, but there's going to be some high inflation. This was back in early 2020. And then also you, Professor Shiller, you actually mentioned that international equities will begin to have good performance following COVID. So this was 4 years ago for those predictions. How did those play out?
Well, the inflation was certainly, since my specialty in monetary theory and policy, and I saw the explosion of the money supply, I just knew that, 12 to 18 months later, we were going to have a lot of inflation. And, and I was warning on it on CNBC, the TVs, many programs. And it was really what I, studied and learned and taught for, over, 50 years, 49 years as a college professor. So, that certainly worked out on the inflation front. It was not temporary. It was going to last for a couple of years, and we would have to bring it down. And we have brought it down, but we've suffered through it, and the American public has suffered through it. And I think the American public, is unhappy with the fact that prices have gone up and their wages have barely gone up as much. And so that was a very important economic prediction.
I'd say you're spot on. And I believe also to you, Professor Shiller, you were referencing that, and at a time, U.S. was very strong. Everything was going really, really well up until April of 2020, it seemed like, and you had a bold prediction of international equities and looking at possibly going outside of the U.S. So how do you think that favored, and where do we sit today?
Well, the forecasts I give are long term. So we've only had 4 or 5 years since that last appearance together. But I think that some of my latest book is called Narrative Economics. And I'm really emphasizing something that many of us have thought about, but never, that stories have a life of their own. They're like viruses, and they spread. And they can last for a long time and then fade into remission and then reappear in an altered form with a mutation. So I think that we were still living in a narrative of Paul Volcker and his strictness that ended the inflation scare. And I think that narrative was driving the inflation. The other thing is the international. I wasn't really giving a precise forecast of international stock market returns. Mm-hmm. It's a complicated scene. There's many narratives operating at once. But I just want to think that Jeremy and I don't disagree on this. I don't think. I remember talking with Jeremy about the importance of bubbles and I'm reminded of Jeremy's book, which I got out again for this. This is Jeremy's book, the future for investors. It really represents. I don't think that Jeremy and I disagree on the importance. So the subtitle of his book is "Why the Tried and True Triumph Over the Bold and the New." Okay, that's exactly the problem we're in. That there's excitement about technology and AI, real excitement. That means that people are telling stories. They love this story about AI, but you have to appreciate that it's a story. It's especially strong in the United States, where we pride ourselves on our IT, information technology.
And well, and I think, and two, I mean, that's a very good segment to one of the things I wanted to talk to both of you on, and Tom. Actually, Tom joined the podcast. It was episode 54, and one of the main clips that a lot of advisors, a lot of people that listen to the show were really just they wanted to know more information on. It seemed like a hot topic was the Magnificent Seven. So that was one of the main things that he just continued to talk about. This was late last year when we aired or when we went through this episode. And Tom, do you want to talk a little bit about Magnificent Seven and what's your thought behind that and the other 493? Just a quick little refresh for the two guests.
Well, you're absolutely right, Jeremy. And Professor Shiller, I actually paraphrased you a lot. I highlighted that it was starting to become evident that the Magnificent Seven was a narrative. And over the last 10 years, you've heard other narratives such as the FANG stocks, and now there has been a transformation that became to the Mag 7. And I highlighted a lot of what you echoed there, that will drive potential momentum and even irrational exuberance, perhaps, and not to say that there's fundamentals that AI is going to really redefine our society, just like the internet did. And Professor Siegel has said that many times when we connect. But is that sustainable? And when you think about the normalization of the economy, we really think the rest of the 493 won't have long-term strength. Maybe not in 2023, maybe not even the beginning of 24 or 25, but long term to really think, is that sustainable? And that's what we talked about. So again, I wouldn't have had that insight if I didn't read your book, Professor Shiller, and connect. So it's great for you to bring it home today.
So it helps that ideas have a name. Magnificent Seven was a nice choice because many of us remember the movie. And so it has a name and it has a reality to it is very poignant.
And do you think, Professor Shiller, and I'll go to you, Professor Siegel, so is it fundamentally driven or is it a narrative for the Magnificent Seven?
Well, it's interesting because the question I have gotten so much, especially earlier this year, was, is this a bubble like the internet bubble? I think that I think the answer is no, not yet. The internet bubble had its magnificent 8 or 9. It had Cisco, Sun Micro, EMC, JDS Uniphase, AOL, Nortel Systems, Oracle. They at their peak were selling at 200 times 12-month past 12-month earnings. The Mag 7 are selling at 35. Now we may argue that 35 is too much or too little or whatever, but it's way less than what we had in that other bubble. But earlier this year, I saw people piling into those stocks, and I was wondering whether we were going to have that same momentum-driven bubble starting. Is this? And it took a few years for it to break. Of course, it broke in March of 2000. So we had a basically we're nowhere near there, and actually 30 it's selling 35 times. Those are the Mag 7 times forward earnings. That's not crazy. I'm not saying it's low or high, but we are not in what was probably the biggest bubble. I don't know. That bubble was probably bigger. Bob was there was 1929, but for that segment of the group, it was probably the biggest bubble ever.
Well, yeah.
I mean, I know the year CAPE ratio I think was higher than, and
It was.
yeah,
The CAPE ratio for the United States got up to 44 in 2000.
yeah. And what was it in 29?
It was in the low 30s.
Yeah, so
We're
it
kind
was
of
a
a-
bigger bubble.
Yeah.
Yeah. I mean, so it was the biggest bubble we were in, and that was really narratives. And Bob talked about future investors, and I've incorporated then in the stocks for long run with then we just have the 6th edition out on that. The narratives that were there that drove those prices began to sound like AI type of narrative. I mean, I think AI is very positive. I've read a lot on it. I don't consider myself an expert. Goldman Sachs, I think, thinks that it has a potential of lifting real GDP growth by 1 to 1.5% a year, starting in around 2025. That's positive. But I still think it's more evolutionary than revolutionary. It's another wave of technology like the internet and like other waves of technology that have come before it.
Good stuff right there. And just to make sure I gave you a chance here, Professor Shiller, you think it's more narrative driven or fundamentally driven for the Mag 7?
That's a difficult thing to answer because there's not just one narrative, and there is new technology here which is revolutionary. So unfortunately, I don't have a lot of confidence in putting out a number. I'm just thinking some of the narratives that were strong in the around 2000. Well, one was the new millennium narrative. This happens only once in 1,000 years. It would be irrational to make too much of that. It's just an arbitrary dating system.
Mm-hmm.
We also had, there was a theory that was talked a lot about a first mover advantage. And it's associated with people. Bill Gates dropped out of college to start Microsoft. He's a colorful figure. He's in the news all the time.
Mm-hmm.
It's not just him.
Didn't Zuckerberg drop out of Harvard to do Facebook?
Yeah, I think so.
And Buffett dropped out of Wharton also.
Yeah. So what's happening is
the richest men in the world all dropped out of college.
So it kind of tells you not to worry too much about price earnings ratios. You got to it's a first mover advantage narrative.
Mm-hmm.
And it's hurting us here in academia. People are not as excited about going to college as they used to be, because the big success stories were independent thinkers who dropped out. So what exactly this means for the stock market next year or the next 5 years is a little fuzzy. I think that it's going to reward forecasters who are less formula driven and more history driven.
Elon Musk did, and Bezos did graduate, if I remember. So they actually stuck it out. Actually, Elon also graduated from Wharton. But yeah, I mean, it's interesting if you would consider those five, men as being, among the richest in the world and prominent. Three of the five dropped out of college.
Yeah. And
Um,
that could be a whole other
that's a whole other,
episode
that's
of
a whole other that's a whole
college.
other topic. But I think we have to think about. I mean, things got. I think. I mean, you can justify 35. You can't justify 200, which was the average PE ratio of those 9 stocks that I mentioned that were so prominent. And these were not the .coms, by the way. These were stocks that were making profits at that time. I'm talking about Pet.com and all the rest. And there was another craze of companies that had like no revenues and no earnings. These were companies that actually had revenues and earnings, but were selling for 200 times earnings. I think that the technology sector of the S&P 500, and that's a select group that has to have an earnings record, was selling for 80 in early 2000. I mean, that also is extremely high. And of course, NASDAQ hit 5,000 and then bust and went down 80%. It went down too much also, by the way. And so it went up way too much, and it's like the pendulum that Bob talks about all the time. The pendulum swung to going down too much. So after the crash of 2000 and 2001, in 2003, 4, 5, the tech stocks were selling it at the same PE ratios, all the growth stocks, as basically the value. And that shouldn't happen either. And that's one reason why growth stocks have done better much better, taking it from that particular time, the early 2000s.
So, Jeremy and I really don't disagree as much as we're known as thought to have. Jeremy got an article, was it in the Wall Street Journal in 2000?
Yes.
Warning about
big cap tech stocks are a sucker's bet. March 14th, 2000, Wall Street Journal called me up and said, by the way, that was one of the most read op-ed pieces we have ever posted.
Maybe you did it.
What? Yeah, I wrote it. It could have been you, Bob, on Irrational Exuberance, but
Yeah.
you know what happened? And by the way, that was exactly the peak of the NASDAQ. And people say, how did you get the peak? And I said, it was just dumb luck. I mean, the Wall Street Journal called me a week earlier and said, Professor Siegel, do you see what's going on in the stock market? I said, oh, of course, that's what I do. And then he said, do you think what's going on is rational? And I said, no, it's crazy. Would you write an op-ed piece for us? I said, yes. And I wrote it, and it happened to be at the exact peak of the craze. So I get a lot of praise that is maybe not deserved, although, I was pointing out that these 200 PE for big cap stocks. We're not talking about small caps, which could have 200 PEs rationally, but these were huge cap stocks, and you can't really grow into 200 PE ratio.
And you referenced pendulum. So, and you talked about the over time. One of the things that Tom actually mentioned on the episode is talking about over I think it was over a decade, Tom, or over a century, where interest rates, so especially with the rising of interest rates from the last 2 years, has been the fastest in the history of our country. Tom, you have the number of like how far back you went with your research to clarify that one.
Deutsche Bank went back to the time of Alexander Hamilton.
Yeah.
We experienced the worst bond market in U.S. history. And then I didn't get that. I don't have access to that data, but I will say I cited Professor Shiller's site. I went back to his data. I think it goes to 1874, and doing some math, and I came out with the same conclusion. Over that time period, it was really the worst bond market in U.S. history. A lot of times, I think people get confused because in the 1970s, bonds were an awful asset class. Rates were at the end with Volcker double digits, but from going from 0 to over 5 in such a quick period of time really created that
As
market.
a percentage change, it was the greatest. I mean, I think in absolute percentage points, we still had a bigger move in the 70s. But we went from 1980, where the 10-year was 14% or 16%, something like that, down to it. I think the 10-year reached 57 basis points right after COVID hit. That was like the biggest bull market. That was a 40-year bull market in one of the world's biggest asset class. It's one of the longest bull markets in a major asset class in world history. And brought it down to really almost crazy levels. 57 basis points on a 10-year government bond. I guess they thought that deflation was going to go on forever. And of course, it doesn't.
And with it doing that, so what is your view on for the foreseeable future because of how fast it increased over the last 2 years? So with the interest rate hikes, what's going to be the impact for the economy, or in any predictions around what's to come?
I have I don't have certainty about what's going to come, but I do know that there are narratives that are fading and some growing. Tom, you mentioned Paul Volcker. There's a story about it. He was when he was Fed chairman, he took the courageous step of slamming on the brakes, and that narrative is still remembered, at least by old timers like us, and came back with kind of giving permission to do an extremely fast rate hike. So I tend to understand what happened.
But Bob, was that a false narrative, or a true narrative?
Well, the people got their facts right. The question is this a safe thing to do? People criticized Paul Volcker for creating what was called back then the Great Recession. So, but it emboldens the current Fed chairman to take stronger action. These things are not set in stone. It's all the story of our times, which is embellished by storytellers. In the news media, it's a competitive business. You have to attract eyes. So the story of the courage of Paul Volcker, who became a moral leader, is still with us.
Right. Let me comment on the current situation. We talk about, the variable R star, which is the real rate of interest, short-term real rate of interest, which the Fed, supply and demand is equal. The Fed, just on their last meeting where they put out the dot plot, raised that R star from 0.5 to 0.6%. And by the way, it had gone down from 2.0% over the previous 10 years all the way down to that 0.5%. I think it's risen a lot more than that. And by the way, to get the actual Fed funds rate, you add 2%. If you get down to 2% inflation, you add that inflation rate. So their long-term forecast for Fed funds is 2.6. I actually think long-run Fed funds is going to be between 3.5 and 4. Now that is lower than what we have today, but not anywhere near the longer-term target of the Fed. I think that R star is rising back to where it was for many, many years before we got into the low interest rate regime. I think faster growth. I think the inflation threats. I think all this is, weighing on the bond market. As far as long-term rates, my projection is we're pretty much at what I think is going to be the long run, around 4.5. I think it probably fluctuate between 4 and 5%. That I mean, if you think Fed funds is going to be 3 to 3.5, 4, you had let's say a 1 point premium onto that for long bonds. You get to that, but that's my forecast on interest rates, and I think stocks can survive that higher interest rate because really they're no higher than they used to be. Pre financial crisis, if you want to go back to that period.
You think Powell will stick to what he said back in December? At least 3.
No, I mean,
rate cuts?
he's already. I mean, we've already backed. I mean, if you take a look at the futures market, they're barely 1 now in December. But again, it just depends on how well the inflation numbers come in. I am actually optimistic about how inflation numbers are going to be coming in over the rest of the year because, as I pointed out many times, the Fed uses this very lagged data on shelter and housing costs. I think they really messed things up by, if they would have looked at the Case-Shiller housing index between 2020, March of 2020 and March of 2022, your index, Bob, went up 45%. That was, I think, and I looked at that. That was faster than any 2-year rise during the mortgage housing boom that preceded the financial crisis. There's never been, in fact, I don't even think there's been a 2-year period where we've seen a rise that fast. And yet the official shelter indexes of the government Bureau of Labor Statistics showed very little rise because the way they do it is they only put a rise in when someone renews their lease, a 2-year lease. They assume that there's no change in rentals until you renew your lease. You're on a 2-year lease, then you don't have any inflation for 2 years. So they were totally, I think totally wrong to look at the current rates of inflation. And so they were underestimating the inflation rate, but now they're overestimating because rental rates have really stabilized and housing prices they're creeping up a little bit, but most of that rise was the first 2 years. And yet now their index is catching up because it's a lag and providing more inflation than I think the real data. So I think in the second half of this year, you're going to get that the government's index is going to pick up the fact that housing prices have simmered down and rental rates particularly have simmered down. Actually, virtually zero year over year for the last year and a half. So I think we're going to get some better readings on that, and that's why I actually think that Powell will have space to cut rates later this year, and move more towards a normal Fed funds rate.
Mm-hmm. And I think, and Professor Shiller, on my last episode, I actually talked a little bit about the experience as a millennial right now, already a first-time home buyer looking for a second home, and the crazy market. I'm in Houston, Texas, so looking for good schools, and the amount per square footage has just skyrocketed over the last year and a half. Good for me as a homeowner, but for a lateral move in this interest rate environment, it's challenging, to say the least, because also homes are going immediately, at least in the areas that I'm looking at. Some people don't even come and see the home and they buy, but that's not the case across the whole country. So what's your outlook on the real estate market? And quite frankly, will baby boomers ever downsize? Is there just too much pride of ownership worth owning the home nowadays for retirees? And actually a second question would be, is it a good time for baby boomers to possibly downsize, cash out, and then look for other, utilizing some of those proceeds for some guarantees, some other protecting that type of asset? What do you think?
Yeah, there's so many factors here. It's hard to come up with a forecast. I think that home prices might well fall, but it's not happening yet. Uh, the thing we haven't mentioned is the work at home revolution. Uh, and the people are not so tied to their center city as they used to be. And so this is something that will take years to work out. There's plenty of land. Cost per acre of farmland is not an important factor in home prices. We could build more, and this is something that I expect to see happening. And more of us will be living hundreds of miles from our workplace, from our former workplace. Also, just the emotional impact of COVID, that we were really scared and we fought solace in our home, safety in our home, and a tendency to think that maybe if we don't move now, it'll be too late. Among some people, not everyone. So this means that I think that home prices could fall, but I don't have a sense that it's imminent or sharp.
Yeah, I would like to add to Bob's comments and yours, Jeremy, about as you said, you're lucky to own a house, but am I right, Bob? I mean, we're in a United States has 2/3, right, home ownership. I think that's the percentage. That means that there's 100 million Americans that don't own their own home; they rent and live with others. And what has really happened with home prices up, 40 to 50%, but look at financing costs, mortgage rates up from 3% up to 7.5% or more.
Right.
Yeah, right.
The cost of financing an average American home has gone up well over 100%. And
that's
over the
amazing
last 4
fact.
years, like 120 or 130%. And the average wage has gone up 20. So people can't qualify now. I mean, the ability to qualify for the average home is now limited to the very few percentile top let's say young couples that don't own now. So I mean, if you don't have parents to help you out, or grandparents, or aunts or uncles, or some family, you're basically out of the American dream, unless unless you're very fortunate. I think that's a source of frustration to those people. Now, when we talk to people that own stocks and all the rest, almost all of them own their own home, but we have to realize how big number that do not own their own home, and they're just faced with rentals and higher and higher rents. They want to buy a home, but now they can't afford it.
And then that's where, so for those that do happen to own a home and maybe have lived there, so going back to like the baby boomer generation, Gen X too, I mean, they've done really well, holding homes for quite some time. Usually that's their, I saw this Y chart study that's their number one asset typically for a Gen Xer is their home. So for baby boomers, does it make sense I mean, you got in at such a low and you've had this home for 30 plus years, and go ahead and cash out, downsize, and take your proceeds somewhere else? Or would that make sense for most of Americans? Or is there, like you said, Bob, more of a tied to the home through COVID and safety and protection?
Yeah, remember that the initial phase of the COVID epidemic hit hard the retirement communities. So people, they want to have their own yard and they want to be there. They can escape from that. Now maybe that's starting to fade, but I think it's still operative.
But I think what you're saying, I think that, I mean, if you do real home prices certainly have gone up, but there is a demand. There's been a shift in demand for bigger homes because people now want a home that has a home office.
Correct.
And they want space. So I think that shift is going to be permanent. So I agree with Bob. I mean, we're not going to see the type of double-digit type of increases we saw from 2020 to 2022, but I think the prices will remain firm and slightly upward. I actually thought when mortgage rates rose to 7.5, we would see a bigger decline. But I look at Bob's index every month very closely. Comes out on the last Tuesday of every month. Is that right, Bob?
Yeah, that's right.
Yeah, and I'm right on my computer watching that scroll, and you saw very little decline, a little bit when Powell started, pushing rates up strongly. There was a little softness in the case Shiller. It did go down, I think 5%, maybe 4 or 5%.
Right.
But it's recaptured that, and in fact gone even higher. But again, we're only a few percent higher than we were 2022, 2023. So the rate of increase has definitely gone on, but I certainly don't see any crash in housing at all. I mean, the crash is in the commercial real estate because of the work at home. And there's where the real crash has occurred. But outside of that, real estate outside of that segment has actually done extraordinarily well.
Mm-hmm. And that's like the tale of two tales here. You got the boomers and Gen Xers that, well, not necessarily Gen Xers, but baby boomers plus who possibly could downsize. But then you got the millennials and those that maybe have their home already, growing families. They're looking for that office space because I'm in that boat as well too. So growing family, more children, add an office space, need more of a larger home, at least to accompany an additional room. So you can sell your home today as a millennial and make out pretty well from what you sold or what you purchased a couple years ago. But that move to a higher, not just price to pay for the home, but the interest rate environment, it's a challenge, especially from you got other people in other, at least in Texas, you got other people from other states that are willing to, once they sell their home, they will just buy without even seeing the house and it's gone.
Right. The
so
Californians think that everything is cheap in Texas, right?
Well, yeah, pretty much. And they're not lying compared to what they're used to. Yes.
Right.
Yeah. So yeah, it's an interesting predicament for the real estate market. And my wife's going to listen to this part of the segment and say, okay, I think I feel comfortable moving. So thanks, guys. So for one of the things too that I did want to actually ask, and this is something that we talked a lot about the AI. We talked about narratives and investing in the U.S. So it seems like every time I turn on the TV, now I hear a lot about college campuses, different conversation, different day. But AI, investing in the U.S., but nobody talks about certain things that are going on globally. So like Professor Shiller, I know you write these amazing white papers. A lot of the audience that watches and listens to this podcast, they actually get your quarterly forecast with Lawrence Black. Right. And you guys have started talking a lot about diversifying, looking at other countries, looking at something like Japan. The Nikkei, I was talking to Tom, or Tom actually pointed this out to me. Tom, isn't the Nikkei, is that like it came back to an all-time high recently?
Yeah, into the spring here in the early part of March, you're right. The Nikkei hit its all-time high after 35 years, as well as the DAX and the CAC market. So developed international markets are playing out, but that's definitely not the talk of the cocktail party in the United States or the TV.
Well, because international has really lagged. I mean, it's come back, Japan, and actually done pretty well last 6, 9, 12 months, but for years it has fallen behind the U.S. But the PE, Europe is selling for around 13.5 PE. The Topics if I remember properly, in Japan is selling at 15.5. These are much cheaper than the U.S. Because you have the S&P is selling for 2021. So I mean, you're there's I think there's no market in the world that's selling for a higher PE than the U.S. Anywhere. I mean, most of them are in the mid-teens or low teens. I mean, you have Brazil is selling at 8. Of course, Hong Kong's selling at 10, and China has its own problems and selling at 11. And most of the others are in the mid-teens. So there's value there. But the U.S.'s growth has actually, even though it has higher PE, its growth has been so much higher that you've still done better in the U.S. But how long can that happen? Where that divergence, I don't think can go on forever. And that's why I think you do see other markets beginning to pick up now. I mean, take a look at India. Is doing very well. I think it's picking up some of the slack from China. Mexico is doing very well, and it's because of the nearshoring. Moving manufacturing plants away from China because of political problems into Mexico. I was in Mexico a year ago, and I listened to a presentation about what's going on in moving factories from China to Mexico, and it's really amazing. That Mexican labor is actually cheaper now than much of Chinese labor, and of course, the proximity to the United States is so much closer that it can be very, very competitive. So we've seen a lot of strength in the peso and strength in the Mexican market. So there's a lot of things going on globally in the present market view.
And so, what about you, Bob? Do you? So, thanks for that, Jeremy. What do you think?
The U.S. has been admired for its technological prowess, and although the first computer description came from the U.K., not the U.S., but the question is, I think there's an emerging sense of unity around the world. We're all sending moon landing robots or the like. We're all very much involved in the IT revolution. So I think the sense of U.S. uniqueness may be fading. And so that suggests some instability toward the valuations that we place on the Magnificent Seven and other technology companies.
Do y'all think there's, to coin a phrase that I got from Tom, and I think he got from one of you? Do y'all what are y'all's thoughts on distilling value domestically or globally at the moment?
Well, I think people should remember that they have to avoid a home bias in their investing. There's a long-standing error investors make to think that it's a good idea to invest heavily in your own country's market.
Well, but that actually has turned out to be good in the last 10 years in the U.S. Mm-hmm. But will it be true in the next 10 years when you again sport a PE ratio 21 versus, you can get the rest of the world at 15, 16 or lower? Is that extra? I think there is that U.S. exceptionalism. I mean, a lot of the invention does still come here. I don't know whether it's spreading out around the world.
It's just a sense I have that Xi Jinping's China is up to date. They created one of the most popular programs, TikTok.
Yeah,
they're in there in the innovation of hits, and this is something that's new to communist China.
We'll see whether that is true. I mean, I think they are second to the U.S. in patent applications. And the World Patent world, but I'm not sure. I mean, you take a look. I mean, certainly they're giving Elon Musk a run for his money on electric cars. So we'll see what other technical innovations they have. And we don't know how much the technical. I mean, now that we're clamping down on supplying technology to, it's harder for them to get it. They were copying a lot of it. Would it slow down as a result of that, or is there enough innate ability there for them to continue to produce? I mean, technically, it could be anywhere. It could be India. I mean, there's lots of places around the world.
Right.
India is the youngest country. I mean, you talk about demography. And young people are the ones that innovate. I mean, India has, as a country, I think the biggest group of younger people by far than any other country. A lot of innovation can come out of India.
That's the sense, yeah, these days, and it's growing, I think.
Yeah, it's doing very well,
And-
and GDP, I think their GDP growth is like 6%. I mean, they've even surpassed China, which was like unthinkable, 10 years ago.
And so, I mean, based off the dialogue here, it's safe to say, I mean, there's a lot of uncertainty. There's a lot of opportunity in a lot of places, and especially what we've seen over the last couple of years. A lot of things that are once in your lifetime opportunities continue to happen here over the last 5 years, it seems like. And I know, especially in 2022, a lot of investors and people may not want 100% equities out there nowadays. So they may want to diversify a little more, take a little risk off the table. And that's what a lot of the advisors that listen to the show, that really read y'all's work, and just y'all's vision and predictions have been pretty enlightening over the years. So they really look for some guidance and viewership. So when they have customers that are looking for opportunities where maybe they're not wanting 100% equities and 100% risk, they want to take some risk off the table. What are your thoughts when it comes to investing in the U.S. today for the American investor, for stocks, fixed income, and have usually some of our advisors now start to use these products such as fixed index annuities. So what are y'all's thoughts around using that into to take risk off the table for some customers?
Well, let me answer. I mean, I could start. The Treasury inflation protected bonds are selling at 2.1%. Stocks at 20 PE, ours is a 5% real yield. I mean, obviously, may want to do a cyclical adjustment for that, but let's say that's where it stands now. So that's now that gap there is almost 3 percentage points as an equity risk premium, which is not. I mean, it's a little lower than the long run historical average that I calculated, but not mammothly so in terms of being different. My long-term stock market is 6.8 over 220 years, and bonds around 3.5. So that's about 3.3. So maybe you're a half a point under that as an equity risk premium going all the way back then. I mean, it is certainly much narrower than it was in 2000, 2001 when tips were minus 1.5%. Bonds have become certainly better, but there's still a gap. There's still a yield gap, and 3% a year over many years does really accumulate as a difference. But certainly you're getting a much fairer shake on bonds now than you've gotten for many, many years.
Could I interject that one thing that we haven't mentioned is the military conflict going on around the Middle East and Ukraine. And the idea that Putin has been threatening uh, uh, this makes me wonder if the important thing that might happen to the market is a kind of World War III scare, which doesn't seem to be on people's attention much. At the beginning of World War One, the New York Stock Exchange was closed for some days
6 months,
because
6 months actually.
yeah, people were trying to get their money out of the market in a panic situation. So there is some thought that something like that could happen again.
You're talking about these black swan events, Bob?
Well, but the black swan events are what people fear the most, and so it can suddenly swing to their attention, and they may exaggerate the probability of. Uh,
Yeah.
I don't think Putin wants to do a nuclear attack on the United States, but in the 1940s, when the Soviet Union tested successfully an atom bomb, that led to a whole exodus from center cities. People moved to the suburbs. They didn't want to be at ground zero. I mean, that's part of the reason for that. So, I mean, it seems like I'm a little surprised that we haven't dwelled more on the anxiety about the unstable military situation.
Well, I think another
Yeah,
black swan event actually could be a cyber attack, not a nuclear attack.
Right, right.
I mean, I mean, we've talked about grid weaknesses that has to do with electricity distribution, but there's also, I mean, we know how many companies have been subject. And what happens if you wake up, you go to computer, and no one can get to their bank accounts, no one can get to their mutual funds or anything like that? That would cause total panic.
Yeah, I'm glad you brought that up. That's another
Yeah,
related
I mean,
fear.
the cybersecurity is extraordinarily important, and you know, yeah, it might be as important as anti-ballistic missiles, which is what, of course, occupied our childhood when we were thinking of fending off the ICBMs that were supposed to come across the North Pole. Remember, Bob, from the Soviet Union?
Yeah,
and I think that's where, I mean, you have black swan events, you have just, you never know what's going on out there in the marketplace of things that are out of control or out of the American investors' control. So that's why a lot of advisors that we talk to daily, they come across people that do want to diversify, take a little risk off the table. So I know that's where really the concept and the asset allocation of fixed index annuities has started to help really become that bond alternative. And I know y'all have written some marketing pieces, not necessarily marketing pieces, but more so good data going back decades of what those can do for actual opportunity as a bond alternative. So where do y'all stand on, what are y'all's thoughts around those type of vehicles like fixed index annuities, and for people that are wanting a little less risk in their overall retirement plan?
well, I think it's a nice example of financial engineering. I mean, the good side of financial engineering. People have exaggerated fears uh, of a stock market. They can suddenly become fearful, and uh, the FIA is designed to tell them also that you can't outlive your wealth. That's a serious problem that many people, you don't know how much you can spend because you don't know what's uh, what's the safety of your investments. So it's a FIA packaging is encouraging good investing behavior.
Yeah, annuities are really important because of that uncertainty of lifespan, and particularly we know about the advances in medicine, and that could significantly increase lifespans in the future, and people have insufficient savings for that.
Mm-hmm. And they do the number one. So there's been numerous articles and studies and surveys. So the number one fear in those that are in retirement or approaching retirement is longevity risk. Um, and I think y'all are hitting a good spot on the fact of health, living longer. Um, I mean, that is a true, and I know both of you gentlemen. So for um, being semi-retired, right? Or y'all, I know y'all aren't necessarily retired. Longevity risk seems to be something typically on the table that people want to remove. So I think the concept of what fixed index annuities have started to allow for people in their portfolio just gives them more peace of mind.
Right.
And that's, yeah, I think peace of mind is pretty strong for anybody looking for some less risk. So, as we are wrapping up here, which has been awesome, it's been great actually chatting with both of you, Tom as well. And as we're finalizing and wrapping up this episode, is there any final thoughts or advice, or more so just things that we may have missed that you wanted to mention before we wrap things up?
Could I just bring up the term diversification? That people very often miss the free lunch that diversification gives you. Investing abroad is not just a matter of picking high good outlook companies, countries. It's also a matter of just avoiding concentration of investments, not letting the powerful narrative over concentrate your current portfolio.
And I would also say it's never too late to start planning, even though you might feel, oh, I've missed the boat, it's too late, and get discouraged. This is important. It's important to face your retirement needs, and if you start now, you're going to be just much better off. Yeah, but for a lot of people, it's psychologically hard to do that. But I think you got to bite the bullet and go forward. You will feel much better having a plan for the future.
Well, so as we're wrapping up here, no, gentlemen, I appreciate y'all both. This has been fantastic. A lot of value and wisdom shared today for our listeners. So thank you, Bob. Thank you, Jeremy, Tom, for taking time to join us on this week's episode. And also thank you to the listener for tuning in. Make sure to subscribe on your favorite listening device so you do not miss out on any future Advisor Mentorship podcast episodes. Follow us on LinkedIn at Jeremy Hauser and also YouTube at Jeremy Hauser AMP for educational clips from our previous episodes. And as you share this episode with a friend, member in a world full of betas, be an alpha. Take care.